Do you ever get the feeling that Wall Street is just a high-stakes casino? I mean, CNBC uses more sound effects than ESPN, Kramer screaming about winners and losers, and charts flying like football stats. But what if I told you there is a way to actually use Vegas-style odds to become a better investor? No, I'm not talking about betting the mortgage on Nvidia like it's the Super Bowl spread. I'm talking about using platforms like Polymarket and Kalshi, where real people are putting real money down on real-world outcomes, from interest rates to inflation numbers, and whether Kanye is going to get arrested this week, because priorities. But here's the magic. Those odds, they're insight. They're the aggregated wisdom of the crowd, and if you learn how to read them, you've got yourself a crystal ball on the stock market. I'm going to show you how to use these betting markets like a pro, not to bet, but how to decode economic events like analysts do, and how to turn those odds into actual investing decisions, including 7 stocks that the predictions are saying to buy now, and how I use it in my own investing strategy. Now, at their core, these betting markets like Polymarket operate like any other market, people putting their money where their mouth is. Each question or market is given a yes, no, or multiple option outcome. Bettors then can buy shares of the outcomes with the price reflecting the odds the crowd believes something is going to happen. For example, if the question is, what will the Fed do in its next meeting in September? We see here there are 4 outcomes. It can raise rates, which is only about a 1% chance. It might hold rates steady, which has 44% odds. It can cut rates by 0.25%, now at about 55% odds on that. Or it can go for the super cut at 0.5%, but that isn't very likely either. Now, how bettors are using this, if you think odds of no change are higher than that 44%, then you can buy in here and profit as those odds change or when that question closes out. This is like Wall Street meets Vegas, but without the overpriced drinks and Mike Tyson. The odds update in real time, meaning they reflect all the new information, sometimes faster than most analysts or even headlines. And here's the kicker. These aren't just people throwing darts, they're traders with skin in the game. That makes these prediction markets arguably more accurate than the financial talking heads, the investing bro on YouTube, or your uncle with his gut feeling about the market. In fact, a 2017 study at the University of Pennsylvania found that prediction markets outperformed both polls and expert forecasts in political predictions. And why? Because the crowdsourcing knowledge, especially when money is involved, tends to filter out the noise and amplify that truth. And that's why smart investors are now using these platforms as a kind of second data feed, not to place bets, but to see how the world is betting and what it means for their portfolios. So I want to show you a few of the ways to use these prediction markets, how to follow the odds, and how it translates to the stocks to watch right now. And I like to start with the big picture, macro-level events. These are those headline drivers to stock prices, like interest rate changes, inflation reports, and recession odds. Betting markets give you a real-time probability map of what that future might look like. For example, on that question of when the Fed will cut rates, we see odds of 53% at its next meeting in September, jumping to 69% in October and higher in December, but that September cut is still a coin flip. If odds start trending higher, or if we see the odds for an even bigger rate cut start trending higher, that is your signal. It's not just bullish for bonds, which rise as those rates fall, but a green light on those rate-sensitive stocks like utilities, real estate, and growth stocks in tech. So using it this way turns those betting markets into your way to front-run market sentiment, not by guessing, but by watching where the crowd is slowly moving its chips. Another important market I watch, inflation here. The June CPI numbers had the market buzzing with inflation jumping to 2.7% pace from a 2.4% the month before. And the market didn't crash on that news, but if it doesn't stop, the next report could tip the balance. That's because Chair Powell and the Fed have to balance 2 rules. Yes, supporting the jobs market and full employment, but also keeping inflation low. Cut rates too much in a booming economy with cheap money, and that's going to send prices higher. That's why following inflation is so important. More than just how much it costs to fill up your tank, but whether it's going to crash your portfolio. That's why I'm following this July inflation market and watching the odds for 2.8% or higher. Odds here have climbed to over 40%, and with another 20% likelihood that inflation goes even higher. If this keeps running higher, that is your flashing red signal. If inflation comes in at over 2.8%, hopes for that September rate cut could evaporate, bond yields would jump, and those growth stocks, watch out below. One way to invest on those rate odds might be the Direxion Treasury Bull ETF, the ticker TMF, which tracks treasury rates with triple leverage. If rates do fall, the price rises, and vice versa here. So if you start to see the odds for that September rate cut increase, that means lower rates are on the way, and this Treasury Bull ETF could see the price jump. Lower interest rates would also be a godsend for the real estate market, still reeling from the 2022 rate hikes and up just 16.8% over the last 5 years, by far the worst performing sector. But that means a lot of unlocked value and time to buy this real estate sector fund, the XLRE, paying a 3.3% dividend while you wait. In that theme, I also like shares of American Tower, ticker AMT. The company is the largest global owner of communications real estate, owning the land and the cell tower superstructures. AMT has more than 225,000 sites across the globe with a strong focus in emerging markets where cell penetration is still growing. The company's recent acquisition of CoreSite puts it in another high-demand property type with 25 data centers across the US. And folks, the beauty of all this is you don't need to understand every economic report or decode that Fed speak. You just need to watch these odds. Here's another market I've been following. What price will gold close at this year? The price of gold shot up this year but is flatlined over the past 3 months and faces a crucial up or down moment. Gold is hitting this highs as central bankers sell their US treasuries to diversify away from the dollar and into gold. This chart of IMF data shows net buying by central banks, and other than 3 months there in mid-2023, central banks have been net buyers of gold, adding more than 50 tons a month to their reserves over the past 2 years. With the price just over $3,300 an ounce right now, I want to know if that sentiment gives it support at a certain level. And we do see that support at $3,200, odds of 72% that it closes out the year at least at that price, or about 4% from where it is right now. That is a signal of support that we can use in our research. Then if we look at these all-in sustaining costs for miners, that's the per ounce price miners need to pull gold out of the ground and make other maintenance costs while still remaining profitable. We can see that some of these companies are cash flow machines at this price. Companies like Agnico Eagle Mines, ticker AEM, with its AISC of $1,227 an ounce, or B2 Gold, ticker BTG, with its AISC slightly higher. Those are cash flow monsters at this point and should remain that way as central bankers buy that gold and diversify away from the dollar. Shares of Agnico are already up 57% this year, but still a good play on the theme, while BTG is only up 12% but pays the higher 2.3% dividend and has a stronger value upside. While it's not the cheapest miner, I recommended Newmont, ticker NEM, on March 5th, now at 42% as one of the safest plays in gold production. Newmont has the advantage of size as the world's largest gold producer with mining on 4 continents and a strong producer of copper and other minerals as well. The company reports over 128 million ounces of gold in reserves alone, and even at that fairly high all-in sustaining cost of extraction, around $1,500 an ounce, Newmont is collecting almost twice of what it costs to dig it out of the ground. The betting markets love crypto, and you're going to find dozens of questions on price and other events. One I've been following lately is whether Ethereum will hit an all-time high by October. Even with the jump lately, the price of Ethereum is still more than 25% off its peak, but sentiment is strong, with 40% odds that it breaks that in the next 2 months and 57% odds that it does it by December. I recommended the Grayscale Ethereum Mini Trust, the ETH, in June, already up more than 50% on the signing of the stablecoin legislation, but this one has a lot further to go. It's now the 5th largest position in my portfolio, up over $60,000. Folks, stablecoins are gonna happen, with everyone from JP Morgan to Amazon and Walmart starting their own coins, and Ethereum is the infrastructure on which all this is built. A new all-time high this year could spark a FOMO moment, and I'm still loading up on that ETH, but also playing it with an option strategy I showed you how to do last month. In that video, I showed you how to set up a call spread on the ETH, buying the $25 calls for $4.60, while selling the 30s for $3.40 each, a net cost of just under $1.20 per share. With the ETH now over $35, that spread is now worth $3 each for a 150% return, but if the price stays above that $30, that spread is going to be worth 316% return, more than 4 times my money. Now, if that 316% potential return sounds interesting, but you're not sure about how to use options investing, look in the description below for a special community discount to our options investing course. You're going to save $150 off the course, get the strategy finder and the options calculator, all with a 14-day free trial, so make sure you check that out. And within that stablecoin theme, I still like shares of Fiserv, ticker FI, as the undiscovered opportunity, even though it's fallen lately. The upside to stablecoins has Circle Internet Group, ticker CRCL, feeding off that hype machine and up 500% in less than 2 months. But Fiserv has the infrastructure and the banking connections to actually make stablecoins work. The company is a fintech powerhouse processing trillions of dollars in payments, digital banking, and services for more than 10,000 institutions and millions of retailers. Fiserv is in the background of nearly every financial transaction you make. Fiserv announced last month its plan to launch a stablecoin platform and its own coin, not only compatible with others, but also setting it up to work with the companies like Walmart and Amazon on their transactions. Shares are trading at a price to sales of 3.8 times, a 32% discount to the average price to sales valuation over the last year. So big upside potential just back to that average valuation, and then even higher with that stablecoin growth. Other stocks to watch as that stablecoin era of digital money takes off are Robinhood Markets, HOOD, with its tokenized US stocks, Coinbase earning fees off Circle's USDC coin as a co-founder, along with its own tokenized stock program, and BlackRock, ticker BLK, which is set to tokenize the $7 trillion money market. Back to another market I follow, and over on Kalshi, you can bet on the 2025 closing value of the NASDAQ 100. Now, the 100 is one of the most followed market indexes, tracking the 100 largest stocks trading on the NASDAQ exchange. It's mostly big tech names like Nvidia, Microsoft, and Amazon, so followed by tech and growth investors, with tech defining this bull market. As that 100 goes, so goes the market. So trader odds on where the NASDAQ is going to end up this year can be a clue into investor sentiment. With the index currently at about 23,500, traders have a 31% odds that it falls below that point over the next 5 months, or 69% odds that the market continues to run higher. But here's the real sign on this one. A full 39% of the odds are very tightly grouped between that current price and 26,000, or about 10% higher. That means after a 12% run in the index so far this year, traders only see another 10% upside from here. And just like the rest of the markets, more importantly is that trend in these percentages. If you see the odds creeping higher, especially the odds of a further extreme upside, that can be a sign of conviction among traders and a clearer signal of the investor sentiment that can support stocks higher. And backed up with other research, that could be your green light to go heavy in those big tech names like Nvidia, Microsoft, Meta, and Amazon, or even using call options to leverage that upside. Looking at the options for the Invesco QQQ ETF, the fund that tracks the NASDAQ 100 stocks, we can see it's trading for just over $572 now, and here on the call options expiring January 2026, call options with the $569 strike price are priced at $37 each. Buying these options gives you the right to buy that QQQ at that $569 strike price, and with the $37 premium, it would put your cost at around $606 per share. So the options market seems to be implying about a 6% upside to the NASDAQ 100 over the rest of the year. But here's where that prediction market odds get interesting. If I think the NASDAQ 100 can rise that 10% through the rest of the year, that would put this QQQ at around $630 per share, making those $569 strike options worth at least $60 each for a 62% return on this investment. Leveraging that 10% upside into a 62% return, that's what options investing is all about. Now, I'm going to give you a step-by-step to using this, what to watch for and how to turn it into an investment next. But the idea here is keeping up to date with those stock market news and the trends shaping the market. For another resource, don't miss our Monday market updates, 9 a.m. Eastern, every Monday morning before the market opens. Check out the playlist here in the corner next for this week's update and all the stocks I'm watching this week. Now, I want to give you a step-by-step to following this and turning it into actionable insight. But what I love about the betting markets is it cuts through all the bullshit. You're not reading opinion pieces and watching 5 talking heads argue about the Fed's dot plot. You're actually seeing where the money is going right now. If 10,000 traders are putting real money on something, that signal means a hell of a lot more to me than some analyst ratings. It's pure market wisdom. And there is a simple strategy for how to use this, and you don't have to be up at 3 a.m. checking the odds. Check in once a week on Polymarket and Kalshi. Look for those big picture questions around Fed decisions, inflation, and market levels. And keep track of these odds and watch the trend, not just the odds themselves. Then ask yourself, what has changed? Where is the sentiment going and why? Then take that to what stocks or sectors are going to benefit if those odds are right or wrong. What direction have those stock prices gone compared to the trends and odds? And is there a disconnect that you can take advantage of? Now understand, folks, this doesn't replace that traditional research we do here on the channel, but it can supercharge it. You still want to dig into the company fundamentals like revenue growth, operating margin, and valuations before you pull the trigger on the stock. That is going to be the bedrock the base of your investing should be built on. Now hear what I'm talking about. These prediction markets can give you the wind direction. They help you see the big moves coming on the horizon before it hits the economy or earnings before it becomes a CNBC alert. For example, let's say you're looking at SoFi Technologies, one of our favorites here on the channel. Like me, you like the long term on the stock, but the valuation of 3.6 times price to book value is extremely high for a bank stock. Now, it's not an issue if the company keeps growing revenue at an outstanding 44% pace through that strong lending. But if you're following this Polymarket odds on September rate cuts and see it start dropping, that could be a warning sign. A cut in interest rates would boost lending demand along with helping fintech stocks, a double boost for SoFi, which is why the stock is doing so well. But if those rate cuts come off the table, then we could see some of that enthusiasm come out of the shares in the near term. It doesn't mean you dump all your shares of SoFi, but it can guide your tactical decisions, maybe covering some of your position or waiting to invest more. Nation, this is about layering insight, using valuation and other fundamentals to find the best stocks, then layering on the macro tailwinds and the trends from these prediction markets. It's like flying a plane. You still need to know how those controls work, but you'd be a fool not to check the weather before you take off. I check Polymarket once a week, not to trade, but to get that first hand of where sentiment is leaning on the big questions for the market. That is important here. Don't hate spam me saying that I gave you a gambling addiction. This is a research tool, not a casino, and I don't want you throwing the dice on your stocks. Get your $150 discount and start using options to boost returns, reduce risk, and create cash flow with the link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.